the yield curve is like my necktie. See my necktie here? See it right here? So normally short-term interest rates are lower than long-term interest rates. And as you move out in time from now into the future, interest rates get higher and higher. That's the normal function because lenders expect to be compensated for more risk as time moves forward, both in terms of fundamental basics as well as inflation risk. So normally you've got this upward slope. Banks are in the business of taking in short-term deposits as the basis for making long-term loans. It's their cost of acquisition. And so the spread between the two is reflective of the future gross operating profit margins of bank lending. The bigger the spread, the more eager banks become to lend and the more lending they do. The smaller the spread, the less eager they become to lend in the future, and then the less lending they do. Or if they want to lend when the spread is smaller, they have to lend to a riskier customer, which is bad. So normally when this spread gets more narrow and short rates rise relative to long-term rates, bank lending and liquidity start to dry up. In some rare times, short-term rates get above long-term rates, as if my tie was going this way. And then when that happens, now there's basically choking off, as if my necktie is pulled, all bank lending. And bank lending actually starts to move into reverse. And that regularly will lead to recession. So the normal sequencing, of which normal doesn't always happen, is as an economic expansion builds, a steep yield curve gets flatter and flatter and flatter as time gets better and better as the central bank pushes up interest rates, and then finally pushes them up too far relative to long rates and chokes off lending, causing bear market and recession.